Picture this. It is Sunday, February 8th, 2026. It has been exactly 1 week since the paper price of silver collapsed from $121 down to $77. The mainstream media told you the bubble had burst. They told you the party was over. They were wrong. While the public was panic selling last week, the smart money was doing the exact opposite. We now have the confirmed data from this weekend, and it is terrifying. While the price was falling, the London silver lease rates quietly spiked to 6.1%. That means there is no physical metal available to borrow. At the same time, the Shanghai Futures Exchange saw 20% of its remaining inventory vanish in a single day. And one man, an American billionaire named David Bateman, just confirmed he used this crash to buy 12.69 million ounces of physical silver. I need you to listen very closely. The crash was not an exit. It was a liquidity trap designed to take your metal, and I'm going to show you exactly how they did it. Where are you watching this from? Let me know in the comments below. To understand why a price collapse is actually a signal of a supply crisis, we must look at the most boring number on the screen, the silver lease rate. Normally, if you want to borrow silver in London, it costs you almost nothing. For decades, the lease rate sat near zero. But this weekend, something broke in the plumbing of the financial system. While the price of silver was crashing on your screen, the cost to borrow physical silver in London spiked to 6.1% for a 1-month contract. Let that number sink in. 6.1%. Why would a bullion bank or a major industrial user pay an annualized rate of 70 or 80% just to borrow a bar of metal for 30 days? There is only one reason: desperation. They need the physical metal immediately to settle a delivery obligation, and they cannot find it in the open market. This is what we call backwardation. It is a condition where the cash price for immediate delivery is trading higher than the futures price. It is the heartbeat of a dying currency and a broken market. And this brings us to the Shanghai Futures Exchange, where the trap has officially snapped shut. We have confirmed reports that on Friday alone, nearly 20% of the remaining silver inventory was removed from the Shanghai vaults. The total registered inventory in Shanghai has plunged to just 11.2 million ounces, or roughly 350 metric tons. This number, 11.2 million, is the most dangerous number in the world right now, because it is mathematically smaller than the short position of one single man. Enter the paper tiger. His name is Bian Ximing. The markets know him as Mr. Beyond. He is a Chinese billionaire who made a fortune betting on gold, but this time he made a fatal miscalculation. We have verified data that Mr. Bian is holding a naked short position of approximately 450 metric tons of silver. Do the math. 450 tons is approximately 14.5 million ounces. The entire Shanghai vault only holds 11.2 million ounces. Even if Mr. Bien bought every single bar left in the warehouse, even if he swept the floor for silver dust, he would still be short by nearly 100 tons. And now, the regulators have frozen his account. He is trapped. He cannot add more margin. He must cover. He must buy back 14.5 million ounces in a market that has no sellers. This is a classic Volkswagen setup. In 2008, Volkswagen stock became the most valuable company in the world for a brief moment because short sellers were forced to buy shares that did not exist. But the situation in 2026 is far worse, because while Mr. Bien is desperately looking for 15 million ounces of paper silver to cover his debts, a predator has entered the water. Enter the physical whale. His name is David Bateman. While the retail investors were panic selling their positions during the 48-hour crash, David Bateman was not selling. He was accumulating. We have obtained a direct statement from Mr. Bateman. He has liquidated his mining stocks. He has liquidated his paper positions. And he has taken physical possession of exactly 12.69 million ounces of silver. This is not a rounded number. This is precise. 12.69 million ounces. That represents 1.5% of the entire annual global supply of silver. Think about the timing. At the exact moment the Chinese short seller needs 15 million ounces to survive, an American billionaire removes 12.69 million ounces from the global liquidity pool. Bateman is not trading for a 10% gain. He is not looking for a quarterly bonus. His public statement is chilling. He explicitly stated that he is buying this metal because, quote, the biggest credit bubble in history will soon pop, end quote. He is referring to the $300 trillion global debt bubble. He also stated, quote, crypto is a psyop. Those who purchase will have no chair when the music stops, end quote. This is a declaration of war against the paper system. So here's the mechanism of the squeeze. On one side, you have a trapped short seller who legally requires 14.5 million ounces to avoid prison or bankruptcy. On the other side, you have a physical buyer who just locked away 12.69 million ounces and has zero intention of selling it back for fiat currency. And in the middle, you have the London vaults charging 6.1% just to lease a bar that might not even be there. The price drop to $77 was the bait. The trap has now been sprung, the inventory is gone, and the entities holding the short positions are about to realize that you cannot print silver. But this is just the tactical battle. The strategic war is much older. To understand where this price is going, we have to look at a pattern that has been forming for 46 years. We have to look at the cup. To understand where the price is going, we must first understand where it has been. We have to look at the architecture of the chart itself. I want you to look at the long-term chart of silver. Most people see a squiggly line. I see a loaded weapon. What you are looking at is a massive technical structure known as a cup and handle formation. But this is not a normal pattern. This pattern has been building for 46 years. Let us trace the left side of the cup. The year was 1980. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the silver market. They understood inflation. They understood that the dollar was losing value. So they bought physical silver and futures contracts until they controlled nearly half of the deliverable supply. The price exploded from $6 to $50 an ounce. The establishment panicked. The exchanges changed the rules in the middle of the game. They raised margin requirements to 100%, forcing the Hunt brothers to liquidate. The price crashed. The paper system won. That was the left rim of the cup. Then came the Long Depression. For 30 years, silver languished in a bear market. This formed the bottom of the cup. Then came the right rim. The year was 2011. Quantitative easing was in full force. Investors rushed back into hard assets. Silver touched $50 an ounce again. And once again, the price was smashed down. We saw 5 margin hikes in 9 days. The price collapsed, entering a brutal bear market that lasted from 2011 until 2024. This period, this 13-year depression, is what technicians call the handle. In the transcript we analyzed, the host refers to this period as the Valley of Doom. It was a time when investors were ridiculed, when nobody wanted to touch the metal, when the price was manipulated down relentlessly by the bullion banks to discourage ownership. But here is the physics of the market. The longer the consolidation, the more violent the breakout. We have just spent 13 years building the handle of a 46-year cup. We are now compressing energy that dates back to the Jimmy Carter administration. And this brings us to the most critical difference between 1980 and 2026. In 1980, the Hunt brothers used massive leverage. They bought silver on margin. That was their weakness. That was how the banks killed them. Today, the buyers are different. Look at David Bateman. He is not buying futures contracts on margin. He is buying physical bars. He is buying fully paid for metal. Look at the central banks in the East. They are not speculating. They are accumulating reserves to back their currencies. The leverage has shifted. In 1980, the longs were leveraged. In 2026, the shorts are leveraged. Remember Mr. Bien in China? He is short 130% of the entire Shanghai inventory. He is the one using leverage. He is the one who is vulnerable. The tables have turned. The hunters have become the hunted. And the geography of the market has shifted. In 1980, the price was set in New York and Chicago. Today, the pricing power is moving east. We are seeing a phenomenon called the arbitrage gap. The price of silver on the Shanghai Gold Exchange is consistently trading higher than the price in London and New York. This acts like a magnet. It pulls physical metal out of the West and sends it to the East. The West is selling paper. The East is buying metal. And now, with the inventory in Shanghai down to just 11.2 million ounces and the inventory in the COMEX registered vaults down to 103 million ounces, the buffer is gone. The handle is complete. The breakout has begun. The chart tells us that once we clear the $50 nominal high, there is no resistance, there is no history, there is only blue sky. Technicians project that a cup of this magnitude does not just go back to the old high. It projects a target that is multiples of the base. That is where the number $300 comes from. It is not a random guess. It is the mathematical projection of a 46-year energy release. But there is one final piece of the puzzle. It is not just about charts or billionaires. It is about the industrial reality of the metal itself. We are not just trading a monetary metal anymore. We are trading a strategic element that is disappearing from the face of the earth. To understand why the vaults are empty, we have to look at the red ink on the supply sheet. Charts are useful for timing, but they do not tell you the why. To understand why the vaults in London and Shanghai are empty, we have to look at the industrial reality of the metal itself. We have to look at the ledger. I want you to focus on a single row in the supply and demand data. It is labeled market balance, less ETPs. This is the only number that matters. It tells us the difference between what the world dug out of the ground and what the world consumed. If the number is positive, we have a surplus. If the number is negative, we have a deficit. Let us look at the record. In the year 2021, the world consumed 144.3 million ounces more than it produced. In 2022, that deficit was 132.2 million ounces. In 2023, the deficit grew to 163 million ounces. And in 2024, the deficit exploded to 210.5 million ounces. Do you see the pattern? For 4 consecutive years, the world has been eating into its savings. We are burning through the above-ground stockpiles at a rate that is mathematically unsustainable. This is not speculation. This is arithmetic. Where did that metal go? It did not vanish into thin air. It vanished into 2 specific black holes. The first black hole is industry. Silver is not just money. It is the most conductive metal on the periodic table. You cannot build a Tomahawk missile without it. You cannot build an electric vehicle without it. You cannot build a solar panel without it. And you certainly cannot build the servers that run the artificial intelligence algorithms that now dominate the stock market without it. The industrial demand is inelastic. Apple and Tesla do not care if silver is $20 or $200. They need the metal to function. If they do not have silver, they do not have a product. But the second black hole is even more fascinating. It is a country, India. While the West was selling paper contracts, the East was backing up the truck. According to the latest data from Whale Insider, India imported an estimated 225 million ounces of silver in the year 2025. Let me put that number in perspective for you. Global mine production is roughly 830 million ounces a year. That means in 2025, the nation of India alone swallowed 1 out of every 4 ounces of silver mined on the entire planet. 1 in 4. Gone. And they are not using it to build solar panels. They are using it as money. We have reports that starting in April, Indian banks will allow citizens to use their silver hoards as collateral for loans. They are monetizing the metal. They are turning silver back into a currency. So, on the demand side, you have a perfect storm. Industry needs it to build the future. India needs it to store wealth. Now, let us look at the supply side. If demand is exploding, surely the miners are digging up more metal, right? Wrong. The data shows the exact opposite. According to Tavi Costa, for the first time in recorded history, global data shows 0 major gold discoveries in 2 consecutive years. The situation for silver is even worse. Phillips Baker, the former CEO of Hecla Mining, is on record stating that it will be the year 2030 before the mining sector can meaningfully increase production. That is 4 years from now. But the crisis is happening right now. Mines are getting deeper, ore grades are getting lower, the easy silver is gone, and because the price was manipulated down for so long, nobody invested in exploration. This is the investment lag. You cannot just flip a switch and open a new mine. It takes 10 years to bring a deposit online. So here is the equation. Demand is vertical, supply is flat or falling. And the buffer the vaults in London and New York has been drained to cover the difference for the last 4 years. And now, we have hit the bottom of the barrel. The Shanghai Futures Exchange has only 11.2 million ounces left. The COMEX registered inventory has plunged 38% since October. There is no buffer left. This is why the lease rate spiked to 6.1%. This is why we are in backwardation. The physical market has decoupled from the paper market. The price you see on your screen is a lie. It is the price of a paper promise that can no longer be kept. When David Bateman buys 12.69 million ounces, he is not buying a number on a screen. He is taking possession of the last remaining chairs in a game of musical chairs where the music has already stopped. This brings us to the final question, the most important question. If the system is broken, and the currency is dying, and the metal is gone, what happens next? What happens when the world realizes that the $300 trillion credit bubble is about to pop, as Bateman warned? We are not talking about a bull market. We are talking about a repricing of reality. So, what is the end game? If the vaults are empty, if the miners are tapping out, and if the paper shorts are trapped, where does the price go? The answer lies in a tweet sent by David Bateman. He did not mince words. He said, quote, "The global monetary system is about to collapse, the Great Reset or Basel Endgame," end quote. He is betting on the collapse of a $300 trillion credit bubble. This brings us to the $300 thesis. You see, $300 an ounce is not a prediction of the value of silver. It is a prediction of the devaluation of the dollar. When the United States government realizes it cannot refinance its $28 trillion in maturing debt without printing an obscene amount of new currency, the denominator breaks. The price of everything real, gold, silver, oil, land, will reprice to reflect the new supply of money. And this is where the warning gets specific. Bateman warns that in this game of musical chairs, the only meaningful life raft is physical possession. He calls crypto a psyop. He warns that those who purchase digital tokens will have no chair when the music stops. Whether you agree with him or not, the logic is brutal. You cannot print silver. You cannot hack a silver coin. It does not require electricity to exist. It is the ultimate hedge against a digital system reset. So, here are the 3 scenarios we are looking at for the next 6 months. Scenario A, the paper shuffle. The exchanges change the rules again. They raise margins. They force liquidation. They try to cap the price to save the banks, but this time, because the physical inventory is gone, the premiums on real metal will explode. The paper price might say $30, but you will not be able to buy a real ounce for less than $100. Scenario B, the slow grind. The industrial shortage forces prices up steadily. We see $50, then $70. The users like Samsung and Tesla panic buy, driving the price into the triple digits over the next 2 years. Scenario C, the force majeure. This is the David Bateman scenario. The shorts default. The COMEX declares it cannot deliver. The price resets overnight to match the real inflation rate. We wake up one morning and silver is trading at $300 an ounce. Not because it went up, but because the dollar collapsed. Michael Oliver, the technical analyst we tracked, believes we could see this move start by March and hit targets by early summer. That is only months away. So, here's my final message to you. Do not trust my words. Do not trust the numbers on your screen. Trust the weight in your hand. If you cannot hold it, you do not own it. The system is blinking red. The data is screaming deficit. And the smartest money in the room is buying everything that is not nailed down. I have compiled the full dossier of data, including the supply charts and the squeeze targets, in the link below. Turn off the noise, watch the vaults, and stay safe.